Welcome to another edition of What the F Just Happened with Dave Kranzler and myself, Eric Dubin. Good time for us to be recording this show, Dave. It's been a while since we last recorded. We were last recorded on April 24th, and yesterday we had a pretty big move in gold, falling down below 1,300. And it picks up on a lot of what we were talking about in the shows that we recorded previously about how it was impossible that we would see a down draft in gold as another washout with this wash, rinse, repeat cycle that happens with the bullion banks and how gold is managed and positioning of traders within the market. What's your thoughts on gold and where we're looking at now?
Well, that's a good question. I've actually been looking for one last sell-off. I was kind of thinking / hoping that 1,300 was going to hold, but I'm usually wrong on that because it always overshoots to the downside, and, at some point it's going to overshoot to the upside on people's expectations. But, we still have a massive net short interest in gold futures on the COMEX from the commercial segment, which is primarily the banks, and the hedge funds are still very net long. And historically, for the last 15, 16 years, when you've had that type of trader positioning between the banks and the hedge funds, gold, at some point takes a big hit. And so I think, what we've seen is the typical shock and awe, call them a fishing line sell-off in gold. And it typically happens as soon as the COMEX opens. No surprise there. What I'm hoping is that we start to get a washout in the open interest on the COMEX and a rebalancing of the positions between the banks and the hedge funds so that the banks are a lot less net short and the hedge funds are a lot less net long. And that is usually what sets up the next rally. So there is actually some good news, and that is just from yesterday to today, and actually it'd be 2 days ago to yesterday, the Holbert Gold Stock News Index, newsletter index, dropped almost 30 percentage points, and it went negative to -2. And what that means is that newsletters that make recommendations on gold and silver or mining stocks, and that's not necessarily dedicated mining stock newsletters like mine. It's any newsletter that includes recommendations on positioning in gold and silver stocks are on balance net short. So, and the Holbert Gold Stock News Index is typically been, as long as I've been following it, which is about 10 years, is typically a phenomenal contrarian indicator. Now, that doesn't mean that just because it went down to negative 2% today that, we're going to see mining stocks rally, put on a strong rally starting tomorrow. It could go more negative for sure. And the more negative it goes, the better, the stronger the bounce back will be. So, but it does indicate that there's capitulation going on. All of the weak hands are starting to wash out. And a bearish sentiment has gripped the sector. And like I said, it's historically, it's been as reliable a contrarian indicator as Kramer or Gartman. Let's put it that way. And I don't want to put a time frame on when I think the next move higher is going to happen. Let's just say that between now and Thanksgiving, I would expect that we're going to be significantly higher in both the precious metals and the mining stocks.
Yeah, and even with today or yesterday's pretty significant move, we're recording this on May 17th. With the gold slicing below 1,300. It's interesting to see how silver has been catching a bid today and that gold has stopped falling and the dollar is not rising all that much. So, the kind of shock to financial markets with gold moving down yesterday is stabilizing today. Silver has managed to get back over 1645 for part of today's COMEX session. Fear that one would expect with follow-up selling just didn't come out today. And that does hint, one can't draw large inferences from this, but it does hint that we just experienced a small washout, and we'll see if the trend continues, and we'll see if people are nervous about the dollar continuing to rise and the perception of higher interest rates harming gold, and we've discussed in our last show how that historically is actually an inference that longer-term value-based investors should not draw, because gold does go up when the dollar is going up as well, too, historically. And given where the economy is and perceptions on where things may be in the future as the economy weakens, as interest rates rise, you and I have been making the argument that the standard equity market is going to go down, that the economy is going to turn down, interest rates would rise, and then we'd have a stagflationary environment, and that all of this would lead to a favorable backdrop for precious metals going forward. What's your take on as far as the dollar and how that moves into interest rate perspectives and the general economy?
Again, I don't like to look at, especially like with the dollar, I don't like to look at the last 2 days or the last 2 weeks or even the last 2 months. So if you look at a long-term monthly chart of the dollar, you can see that the bounce that we've had this year from 90 on the dollar index up to right now it's at 93.40 essentially. That bounce barely registers in terms of the movement in the dollar index, and I'm using the chart that's on FinViz, the monthly chart that goes all the way back to 1994. So I do think that, well, if you look at, say, for instance, the 2008 period, we had the dollar went straight up. I remember because the dollar almost broke 70. And it went essentially rose from 70 to 90 in a very short period of time. And that it preceded and accompanied what I call a de facto financial collapse of the system. So the spiking dollar, as opposed to being a reflection of a bullish indicator for the U.S. system, was actually very negative. And part of what drove that was massive scramble by foreign countries and companies who had issued dollar-denominated debt. They were trying to get their hands on dollars so that they could make their debt payments.
Right.
And that's essentially the huge run-up in the dollar made the whole situation worse. Well, we could be on the cusp of seeing that happen again, because I have been reading numerous articles that the supply of dollars overseas is shrinking. It's a function of both U.S. corporate repatriation of dollars now that the tax on repatriated dollars is minimized, and also the fact the Fed's not printing money right now. So it's on a relative basis, relative to the amount of dollar-denominated debt that's been issued. There's a relative shortage of dollars versus a year ago, and that could be driving the latest rise in the dollar, and it certainly could get a lot more severe. But again, I would argue that to the extent that it does, it's a negative indicator for what's going on systemically beneath the Orwellian surface.
And when we were talking on our last show on April 24th, we were talking about how the 10-year had just pushed up to 3%, and that people's understanding of what would be going on in the economy as a result on a going-forward basis, and in turn market reactions, were about to shift on a going-forward basis. Since then, we have cooled off. We saw the equity markets do reasonably well in the rotation, and then the 10-year has now moved to 3.10% on its yield basis, and that's pressurizing the economy. You've been seeing and reporting in your short sellers journal shifts that are going on when it comes to restaurant sales, and how there has been an increase in inflation that one can understand in our system, yet the average financial market participant is celebrating how restaurant sales have been going up, when in fact it's rather been the price of an average meal ticket, and that the number of diners has been declining. Trends within the auto sector, trends within mortgage finance. Can you speak a bit about that and how you see this shaping the way our economy is going to roll in the months ahead?
If you measure the rise in interest rates from January 1st, 2017 to now, the 10-year yield's only gone up 70 basis points. That's less than 1%. And people are freaking out over the 10-year yield going over 3%. And to me, what that speaks to is the fact that the Fed has dumbed down all of the warning indicators with all of the money that it printed and the amount of credit creation that it enabled, that very small changes or a very small rise in interest rates can really throw the whole system off keel and take a big whack out of economic activity. We're already seeing that. For instance, auto sales are rolling over. Housing sales, despite the propaganda about hot markets, yeah, there's some limited areas where markets are hot. It's mostly in areas where Californians are leaving California and moving to, like Phoenix, Vegas, and Denver. But in general, housing sales are rolling over. The restaurant report that came out from Black Box about a week ago, you know, the propagandists there were all happy because the comparable store sales were up 1.5% year over year. Well, you shift over to comparable store traffic and it was down 1.5% year over year. So what does that tell you? I mean, it tells you that if you got less traffic into these restaurants, but revenues are rising, it means prices are rising, and it's rising much faster than traffic is leaving. So, and on a rolling 3-month basis, comp store sales are only up 0.6%, but traffic is down over 2%. So, and that's because people have less disposable income to spend, especially when you start looking at the you know, breaking it down by income demographic, you know, the under 90%. I mean, not, you know, the under 10%, so call it the bottom 90%. Those people are living hand to mouth, paycheck to paycheck. They've got debt coming from their eyeballs, and this is not a good economy for them. So for most of the country, it's not a good economy. And that's happened with a very small increase in interest rates. What's going to happen when the 10-year goes up to 4% and all of a sudden you've got mortgage rates well over 5%? I mean, that's just going to crush this system.
So, Dave, before we wrap up the show, let's circle back to gold. And that was the biggest move that we saw yesterday, and this is of most interest to our listeners. When we look at the really big picture and try to put into perspective this rebirth of this stealth bull market, gold looks fabulous, even though sentiment absolutely stinks. And we have seen indications that this is kind of a stealth washout capitulation. But when we look at the bigger picture, from the last 2+ years, gold has been performing really well. And what's your take as far as how you see gold going forward this year in relation to rising interest rates in the economy?
Here's the thing. I like the idea of looking at it over a longer term time frame. Specifically, look at it since it hit its bottom at 1060 in mid-December 2015. You know, if you pull up a chart of that, you'll see there was a 30% burst higher in the price of gold in a 7-month period. Now, part of that was overshooting the capitulative selling that just preceded gold bottoming out, and you can see that if you take your chart far enough. You know, but 30% in 7 months is going to be corrected, and it deserves a correction. It's not healthy, because if it keeps going at that rate, it means you're going parabolic, and that's not healthy either. So we had a 30% increase in 7 months, and then it obviously, gold was slammed again by the end of 2016. And if you draw a line from mid-December 2015 to mid-December 2016, you probably had about an 8% rise in the price of gold. And that, to me, that's a healthy investment return. I know everyone's felt entitled now ever since the dot-com era that if you don't double your money every 6 months, you're doing something wrong. Well, that's absurd. So, and then if you just look at from the end of 2016 to where we are now, gold's in a very healthy uptrend. And as you pointed out, Eric, you can draw that uptrend line all the way back to mid-December 2015. So in terms of what's happening with gold now, yes, it's extraordinarily frustrating that it keeps banging its head on the 1360 area and can't push through. Well, guess what? I lived through this when gold was trying to push through 400 back in 2003, early 2004 time frame, and it seemed like it took forever. And back then, Robert Prechter came out and said gold was going back to $50. Well, not only did gold not go back to $50, it pushed through 400 and then and took off, and it peaked out in, I believe it was May of 2006 before it really had a big correction again. So I don't remember the price where it peaked out, but so at any rate, I mean, I would argue that from a technical standpoint, the chart I'm looking at for gold looks like it's a market that's in a very healthy bull market with, price rises and corrections and a general uptrend. And I don't have a problem with that. Yeah, gold did pop below the 200-day moving average a couple of days ago, but guess what? The chart I'm looking at, it popped below since 2017. Since the beginning of 2017, it dropped below the 200-day moving average 3 previous times, and that's the point at which it started rallying again.
Yeah.
So, and let me just clarify something here. I'm not saying we're not going to go lower here. I'm actually thinking we could get one nasty capitulative sell-off drop here, and if you're not nibbling away at gold and mining stocks here, that's the hit that you want to start buying.
And if we were to see something like that, it would probably be in the neighborhood of 1250, give or take, based on just, where technical analysis motivated traders would be looking at the markets. But, last summer, in the July time frame, we were having a lot of crazy action in the precious metal space. We had flash crashes going on, and sentiment fell really low. And that was the period where gold based out, and it bounced off of this trend line that we were speaking of just a moment ago that asserted itself at the end of 2016. We saw the same thing going into the end of last year, and sentiment was horrible. People thought that gold would continue to go down. A lot of people were even looking for us to even break 1,100 as the Fed would normalize its balance sheet, et cetera, et cetera. And now we're in a period where we're in this general trend line again, in this stealth bull market. And though we may see gold get hit again, it looks like we have the conditions where people are buying this dip. We saw a lot of action yesterday and selling off, yet today we're seeing people come in and buy silver in particular, and that's a pretty decent indicator of sentiment in terms of the very smart money and the bottom fishing people that are looking to establish positions. So time will tell, but we're making the argument that interest rates rising will hurt the economy, which will hurt the stock market, and in turn give a bid to alternative assets, generally speaking. And we've been in a stealth bull market all this time, even though sentiment is horrible and people hate the precious metal space. We're still hanging in there. We still have had this stealth bull market. It's how many times have we had to endure people saying that gold is going to go to 1,000?
And one last thing I just want to point out here, because to me this is also a leading indicator. If you're talking about the remarkable resiliency of gold here. If you look at the mining stocks, I mean, the Hewlett index basically, again, I'll probably jinx it, but they can't get it to all the selling and negative sentiment won't push it any lower than where it is right now, at least for now. I mean, it hit 170 at the end of March, and it rallied back up to 185, and it's been kind of bouncing around between 175 at the outside and 185 on the upside. So again, I think the resilience that you referenced is being reflected in the trading action in the mining stock.
Well, thanks everyone for listening to our latest episode of What the F Just Happened. And if you'd like to follow Dave's work, you can check out his stuff at investmentresearchdynamics.com. You can follow my work and postings over at Facebook at facebook.com/Eric Dubin. This show is brought to you in part by Wall Street for Main Street, and the YouTube channel that you're listening to features all of Wall Street for Main Street's productions. So click on the channel and check out all the other things that Wall Street for Main Street produces. Thanks for listening, and we'll be back to you in the weeks ahead.